The $1,000,000 Treasury question at the moment is, did you miss the peak? Hello members and super savers, I hope you're having a good week. This video is the follow-up video to the one we posted a few days ago on the recent drop in Treasury yields. I've linked this in the video description below for those of you who haven't seen it yet. Because the top of mind question that many of you have been asking us is, did you miss the peak? As I shared in our member zone a few days ago, no, I have not changed my opinion of peak rates at this point in time. So with that in mind, these are the 3 topics I'll be covering in today's video. As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, financial folks. As we shared with you in this last video on the recent drop in Treasury yields, this is why we think bond yields dropped so much the first week of November. 1. The Fed skipped a rate hike. 2. The quarterly refunding statement that the Treasury issued was better than the market had expected. And 3. The jobs report showed job growth slowing more than expected. These 3 events happened all within days of each other. These 2 happened on November 1st and this one on November 3rd. The bond market will take any piece of good news these days, in my mind, given that bond fund managers are heading for the 3rd year of losses for the first time in decades. As Reuters pointed out in this article we've already shared with you. And in fact, this second event, the quarterly refunding statement that the Treasury issued, was better than the market expected. It actually sounded like good news on the surface. The core message was, yes, the Treasury is borrowing more debt, but it's less more than the markets had expected. And if this less more part sounds confusing, you're not alone. And that's why it took us the better part of this last video on the drop in Treasury yields to explain this. So as I just said, borrowing less more debt paints a rosy picture when taken at face value. At least it did to the bond market. But when we dive deeper into the facts and look at the actual and projected fiscal spending numbers, as well as the fundamental supply versus demand of Treasury auctions, the story that we see is much less rosy. It's a story of a country with an ever-growing dependency on debt issuance and deficit spending, and the ever-increasing interest costs that come from that mounting debt pile, which brings us to the 5 reasons why we don't think you and I have missed the peak on Treasury rates. At this point in time, get ready for these charts and tables that I'm super excited to share with you. And I need to clarify, excited in a professional sense, not necessarily excited for the long-term health of our nation's financial condition. But back to the charts and tables. I do think they really bring home all the reasons why Treasury yields need to go higher for the foreseeable future. Reason 1. Our government's debt is projected to rise to never-before-seen levels in the coming decades. According to the Congressional Budget Office, at the current time, our country is looking at debt levels as a percentage of GDP that were seen the last time after World War II. And over the next decade, debt held by the public is projected to rise in relation to GDP, mainly because of increasing interest costs and the growth in spending on the major healthcare programs and Social Security. And if we look into the future even longer, basically debt rises in relation to GDP continuously over the next 3 decades, exceeding any previously recorded level, and it's on track to continue growing even after 2053. My kids were really not happy when I shared this one with them. Bloomberg actually has a great chart of the growing US budget deficit as a share of GDP, and these numbers really do not look pretty. And to make matters worse for this debt situation, let's move on to reason 2 for why we don't think you and I have missed the peak on Treasury rates. 51% of US debt is expected to mature in the next 3 years. 51%, my financial friends. That number blew our mind in a bad way when we first heard it. According to this economic synopsis by the Federal Reserve Bank of St. Louis, we can see that 30% of US debt is expected to mature in 2023, of which more than half is relatively short-term debt. 12% of US debt is expected to mature in 2024, and 9% of US debt is expected to mature in 2025. Add these three columns up, and we have the 51% of US debt expected to mature in the next 3 years. And that maturing debt will need to be refinanced at higher rates than they were previously. That's the most likely scenario, which brings us to reason 3 for why we don't think you and I have missed the peak on Treasury rates. Interest expense is estimated to become an increasingly larger percentage of GDP as the Treasury refinances ever-growing amounts of debt at higher rates. So going back to this analysis from the Federal Reserve Bank of St. Louis, if we scroll down to this table, we can see that our government's cost of borrowing went up from an annual interest rate of 2.3% in December 2022 to 2.7% in April 2023 already. Good luck getting rates like these when it comes time to refinance this 51% of US debt that is expected to mature in the next 3 years. Because as many of you already know, this is what Treasury rates across the maturity spectrum look like at the moment. In fact, interest payments as a percentage of GDP already went up from 1.86% in December 2022 to 2.23% in April 2023. And if we scroll down further, we can see that interest expense as a percentage of GDP is expected to cross above 3.5% by 2033. And to add more fuel to the fire, let's move on now to reason number 4 for why we don't think you and I have missed the peak on Treasury rates. The Fed will continue to let up to $60 billion in US Treasuries run off its balance sheet each month, meaning that the Treasury needs to find new buyers to replace these up to $60 billion of US Treasuries that the Fed is letting run off its balance sheet every month. This offloading of Treasuries from its balance sheet is such an important part of the Fed's overall quantitative tightening process that Fed Governor Powell mentioned it 3 times in the first 6 minutes of the most recent FOMC press conference.
And we have decreased our securities holdings by more than $1 trillion. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings.
This brings us to reason number 5 for why we don't think you and I have missed the peak on Treasury rates. The Treasury's own Borrowing Advisory Committee, TBAC, has already told them that rates need to go higher on the longer end if they want buyers. Now, they didn't say it as directly as I just said it, but that was the underlying message. Here's the report to Treasury Secretary Yellen from the Treasury Borrowing Advisory Committee, TBAC, that was released on October 31st. If we scroll down, we can see that TBAC states, Treasury auctions continue to be consistently oversubscribed, but there may be some early evidence of waning demand. And specifically, they talked about the growing imbalance between supply and demand, the $1.7 trillion fiscal year 2023 deficit being larger than originally forecasted, and that both the private sector and official projections expect a similarly large deficit next year. Plus, the fact that investors may now require an additional yield or term premium to hold longer-term debt. In plain English, investors may demand higher yields for longer-dated treasuries. I've linked this TBAC report in the video description below for those of you who might be interested in more detail, because the TBAC team that presented this report, do you know who they are? This is them. Not exactly your everyday run-of-the-mill Jack and Jill, the co-head of global rates at Citigroup Global Markets, the head of markets at Element Capital Management, a managing director at BlackRock, the chief investment officer at Vanguard, and Fidelity. You get the picture. These guys and girls on TBAC, they basically represent the buyers of the same US Treasuries that they now see early evidence of waning demand for, that investors now may need higher yields to purchase longer dated ones for. As I always say, I'm not a betting kind of girl, but if I were, I would bet that the Treasury heeded TBAC's warnings about the early evidence of waning demand and need for higher yields on longer-dated U.S. Treasuries because, surprise, when the Treasury announced the planned increase in auction sizes for Q4 versus Q3, so for October, November, and December, they increased the auction sizes for the shorter-dated U.S. Treasury notes significantly more than the longer-dated ones. In fact, they didn't increase the auction size for the 20-year bond at all. Looking at these numbers could almost make one think that the government is trying to finance its growing budget deficit on the shorter end of the maturity spectrum, like an expensive revolving credit line, in the hopes that overall rates will come down to levels that are more amicable at some point. So, all 5 of these reasons taken together, they lead me to conclude that no, we don't think you and I have missed the peak on Treasury rates. And that basically, as we said in these recent videos on whether Treasury yields would continue to go up, yes, we do think yields will go higher, albeit not necessarily in a stable linear path as they have been doing so since early 2022, which is a great segue into the next section of this video. I, for one, think that there are only 3 sustainable scenarios which would lead Treasury rates to stay where they are or to even go lower right now. And I don't believe any of them look very likely at this point in time. Here are the 3 scenarios. 1. The government decides to rein in its spending and starts lowering the budget deficit substantially. But such a fundamental change in fiscal policy takes time and does not happen overnight. So it would not allow the Fed to start lowering rates now. 2. The Fed gives up on its 2% target and accepts a permanently higher target inflation rate, which again would allow them to start lowering rates now. This is possible, but unlikely, I think. While we can definitely find some media headlines arguing in this direction, Fed Governor Powell is always very explicit that he and his colleagues at the Fed are deeply committed to getting inflation back to a sustainable and stable level of 2%. And I don't think he'll abandon this pledge overnight either. 3. The U.S. economy enters such a deep recession that the Fed has to lower rates quickly to prevent the economy from collapsing completely. Think the Great Recession of 2008, or another series of bank collapses like earlier this year. Personally, I think this is more likely than scenarios 1 and 2. Needless to say, we hope scenario 3 won't happen. But listen, I don't have a crystal ball, and it is something that we are watching. And as always, if you want to watch along with us, drop a comment below and let us know. Of course, the government can also delay the inevitable a bit and issue its growing debt pile at the shorter end of the curve, even more than it's doing already. Issuing more of the federal debt at the short end of the maturity spectrum will help long-term Treasury rates to stay lower than they would otherwise if the financing was more evenly spread across maturities. But this is a tactic, not a strategy for a country like ours, at least not in my mind. It would be a bit like putting a long-term debt like your mortgage on your credit card. And I don't think this would be sustainable or healthy long-term for our federal finances. Plus, with the current inverted yield curve, it's even more expensive than issuing long-term financing. And never mind the fact that doing this is practically an invitation for another credit downgrade, which would make issuing treasuries even more expensive overall. Now, while I think we're not about to see rates going lower anytime soon, they will start coming down at some point. And you certainly won't miss the memo on when we think rates have peaked if you watch this channel regularly. Because, well, I'm going to tell you, just like I'm telling you now, that we don't think they've peaked yet. Which brings me to... Here's what I think you can do as a bond investor right now. First, turn down the noise. It seems I've been saying this a lot recently, and that's to be expected, I suppose, because there is a lot of noise right now in the bond market. Where there's market volatility and uncertainty, there will be noise. Second, stick to your long-term investing strategy. Everyone's financial journey is different. But as usual, consider laddering and not putting all your eggs in one basket at the same time. And third, subscribe to our channel. In fact, join our Super Saver membership and be one of the first to know about what's happening in the world of bonds, and to deep dive into the videos that we create on this channel to support your fixed income journey. Now, I do have a few more details that I can add to this to-do list for bond investors in the current environment, but I'll save that for another video if there's enough member and Super Saver interest, because I think this video already has a lot of important information that needs to be digested first. If you're interested in such a to-do list for bond investors video though, do leave a comment below and let us know. Also drop a comment below if you're so inclined. How's your fixed income portfolio doing right now? And what do you think? Are rates going to go up, down, or sideways? And which of these three scenarios do you think is most likely, if any? So, I do hope that this video helped you see the bigger picture through all the noise and gave you some peace of mind during these volatile and uncertain times. And listen, if it's useful, bookmark this video, and when the bond markets hit another rough patch again like they did last week, come back to these 5 big picture reasons on why we don't think you and I have missed the peak on Treasury rates just yet, and reassess the situation. All right, members and Super Savers, as always, if you enjoyed this video and learned something new, I'd love to invite you to continue to support our channel through membership so that we can keep producing one-of-a-kind, objective, sponsorship-free videos for you and for Super Saving community. Come for a chat at our next live member Q&A on November 17th at 5:30 p.m. Eastern Time, and check out our latest member videos. Take a look at this video here to learn more about Diamond NestEgg membership, or visit our channel page or the join link in the video description below. See you again very soon with more brand new wealth building content for your financial journey.